Hiren Ved is joining us right now. He's a Director and Chief Investment Officer at Alchemy Capital Management Private Limited. Hiren, thanks very much for joining us. Good to have you here. Simple question. Is it going to get a lot worse for the market from here?
Well, I think, we're obviously in the shadows of what's happening in China right now. And to my mind, that might continue to weigh on markets in the near term. But my sense is that there's not much of a big downside from current levels for the Indian markets, because in the overall emerging market context, India is still relatively better placed amongst most other EMs. So I think the markets, to my mind, should remain resilient, around these levels. It may be difficult to build a case for a big up move, but I don't think that there is significant downside from current levels.
Is there a possibility of heavy foreign selling led downturn, drawdown on the market?
I think that, that's exactly what I meant, because there are, frankly speaking, direct linkages with China are far less. The biggest linkage is essentially through foreign flows. And typically when such a large emerging market gets into a challenge, the entire asset class gets sold in. But I think the difference here is that domestic flows, at least thus far, have been pretty resilient. And to my mind, some of the domestic flows should be able to absorb the incremental selling that might happen. Let's not also forget that significant outflows have already happened in the last 1 year. I mean, we've already seen, close to, $8-9 billion of outflows happening from India. So incrementally, my sense is that the outflows may not be that significant, though in the near term, because of the China factor, you could see pressure continuing. But my sense is that domestic liquidity will absorb, at least if not hold, the part of the selling that is happening right now.
This is obviously all, Hiren, based on the assumption that FIS will continue to see India as a market where future growth prospects are still strong, right?
Absolutely. I think the problem here is that what's happening is that today, if you look at the composition of FII investments in India, the passive investments through ETFs and global emerging market funds and global funds is probably twice the amount of money that is invested by India dedicated funds. So that's why, this pressure is so overwhelming. I don't think that India dedicated money is going to be bearish at current levels of the market. In fact, India, if anything, as I mentioned earlier, is likely to remain on a relative basis a brighter spot. So people would rather use this weakness as an opportunity to build positions in India rather than sell down India at current levels.
Hiren, what about flows into domestic equity mutual funds? Because if you look at December, flows into equity mutual funds halved from the average.
Absolutely. Retail investments always follow near-term returns. And since near-term returns have been difficult, I do expect that flows will slow down, but I don't expect them to be negative. Because typically what happens is that retail investors or domestic flows generally don't tend to sell when the markets are lower. So my sense is that people will probably, and I also see that to some extent the domestic flows have matured. I mean, domestic investors have matured a bit, and they might also look at this as an opportunity, though I do agree that absolute flows might not be at the levels that we saw, let's say in May, June, July 2015, when markets were really doing well.
Many have said that this flow into domestic mutual funds is part of the overall financialization process, and it's a secular trend. Do you believe that? Or as you began by saying to my last question, retail flows kind of take their cues from near-term returns?
My sense is that it's a secular trend. I think that there are two things that have happened. One is that the amount of money that is now flowing into equity mutual funds via SIPs is far greater than, let's say, what it was a couple of years ago, right? So that flow will continue. Secondly, as you rightly mentioned, that alternative avenues for investments are not doing well as well, right? So I think that probably equity markets still continue to be, and also I think it also depends on the experience of each of the retail investors. While overall the market hasn't done well, but the small and mid cap stocks have done extremely well, and last 2 years the mid cap funds have delivered absolute returns which are in the range of 60 to 100%. So investors who are invested in those funds have had a good experience. So my sense is that flows into equity markets on the domestic side, though not at the level that we saw middle of last year, but I think will continue.
Okay, now a simple question again. Is there a bubble in mid caps and small caps now, Hiren?
Well, I wouldn't say there's a bubble, but I certainly believe that one has to be cautious, because from a valuation perspective, for the first time we've seen that small and mid cap valuations are running higher than large cap valuations, and the last time this happened was in 2005 2006, but the scenario then was quite different. Earnings were expanding at that time, and typically mid and small size companies have a better operating leverage in an up move cycle. We are not experiencing that. In fact, we are seeing continuous downgrades. But what's happened is that essentially because FI net selling has happened, which is largely concentrated in the large caps, and domestic money has largely flown into mid cap mutual funds. There is a divergence in valuations. So I think if you generalize today, I think large caps definitely have greater value than small and mid caps. So I think people have to be very careful. But having said that, there are always individual opportunities even in small and mid caps where people can make money. So it's really going to depend on earnings growth. If people can find companies that can grow earnings faster than the market, today the markets are willing to give a premium for earnings growth. So if some small and mid cap companies are able to deliver higher growth, they may end up trading at higher multiples.
But I mean, taking off from your last answer, making money in mid caps and small caps is going to be easier said than done now, right?
Absolutely. I think incrementally the risk reward is definitely in favor of large caps.
The other reason given for sticking to smaller companies is that large companies, at least the top 100 companies in India, are majorly linked to the global scene, materials, energy and other sectors as well, and that is going through a big downturn. Hence focus on the companies outside the top 100 companies, where you'd more likely find plays on the local story. Is that a convincing enough reason for you, Hiren, to keep looking there? Or you think, the risk reward just plainly is out of whack?
No, absolutely. I think there are two things happening. One is that the exposure of large caps to commodities is also significantly higher. So both, larger companies are more global than smaller companies, and their exposure to commodities is also higher, right? And that's why we are seeing that revenue growth and profit growth has been so tepid. As opposed to that, if you want to bet on largely consumer-driven businesses, or you want to largely focus on domestic-driven businesses, you are seeing opportunities. You can find those companies in the small and mid-cap space. The other reason why small and mid-caps are doing very well is because of the couple of IPOs that have happened recently, which have done exceedingly well on the markets. which basically creates a positive feedback loop. Once you start making money in a couple of IPOs, money tends to flow to those names as well. So I think it's also about getting fresh opportunities and new names to bet on where there is no previous history, and that's also one reason why small and mid caps have done quite well.
But as they say, there's a good thing and then there's too much of a good thing, right, Hiren?
Yeah, absolutely. So as I said, one has to be very careful.
So you said large caps risk reward is much better. Where exactly?
Yeah, so I think, if you look at the large cap space, we've recently seen correction in the auto stocks. Partly it's happened because of what's happening in China in case of stocks like Tata Motors, but also because of the whole issue of strictures on diesel vehicles and the fact that the rural economy has not done as well as the urban economy has done. So many ancillaries as well as automotive companies have corrected sharply from their highs. So that could be one area of opportunity if one is a long-term investor. Cement could be another area where valuations have gotten cheaper, compared to where they were, let's say, even about a year and a half ago. Obviously, volume growth has been pretty tepid, but this is an industry where the capacities are fairly consolidated. And if there is a domestic recovery in infrastructure, which we are beginning to see, especially in areas like road, etc., this is a sector where you could even tend to play regionally, right? So you could have a situation where maybe one region is not doing well, but another region is doing well. So for example, people are very bullish on the whole build out of the two new states like Andhra Pradesh and Telangana. And there could be demand there incrementally, or there could be higher demand from east and northern parts of the country. So it really depends. There could be opportunities there because valuations have gotten cheaper, and the industry is fairly well consolidated, and the industry doesn't have the kind of debt, let's say, that they had in the previous expansion cycle, right? So there could be opportunities there as well. And then I think the private banks continue to offer good opportunity, obviously in spots. So I think there, and then to my mind, even some of the consumer companies should be able to do well, because we've seen another leg down in oil prices, and that should give them some leverage on their costs and help their gross margins. So again, depending on the competitive intensity, they could either decide to pass it on, or they could decide to keep some of that margins, which should help profits. So there are pockets within the large cap which could offer opportunities.
Hiren, what's the basic call on Tata Motors? Let's just start one by one and just touch upon a few specific names. Are you saying the decline and the future potential decline in China will be more than made up by the US market?
Yeah, I mean, incrementally now China volumes are down to 14% of total JLR volumes, right? But, from a sentiment perspective, we do continue to see that, as challenges in China come to the fore, the stock tends to underperform. But if you see recent volume numbers that have come out from JLR, we've seen pretty strong numbers on the back of new launches. And I do believe that, the stock has definitely got into a value zone. Most of the risk seem to have been priced in. And it does offer upsides from current levels.
It also kind of ties in with the broad theory that good times or bad times make sense to bet on products or companies making products serving the wealthy.
Yeah, and also I think if you look at the base, if you look at most of their competitors in the luxury segment, luxury car segment. They're much bigger than what JLR is, right? So JLR is still running at a run rate of 600,000 vehicles. Can it go to, let's say, 1 million cars in a couple of years? The answer is yes. The opportunity does exist. And they do have a pretty strong lineup of new products which are there, which should be able to drive growth for the next couple of years.
Auto ancillaries, you also mentioned that pack. Where exactly? What names exactly?
No, I think, if you see some of the larger auto anchors, they have corrected, whether it's Motherson, Sumi, whether it's the likes of Bharat Forge. These are, obviously there have been near-term challenges in both these companies, but, the valuations are significantly off from where they were at the peak. So if you're a long-term investor looking 2-3 years out, there could be opportunities sometime during the year to accumulate some of these names.
Any specific thoughts on Maruti? It's also corrected recently, but that's largely been related to the currency. But any thoughts there, Maruti?
Maruti, I think, will continue to do well. Obviously, it's been a standout performer in 2015. And, I think that Maruti has a certain unique advantage in the sense that they are strong both in rural as well as in urban areas, right? So what happens is that if rural is not doing well, urban does well. There again, new launches have been pretty successful. The recent weakness has been more to do with what's happened to the yen. So I think from here on, incrementally, if the yen strengthens, then, you may have some bit of correction. But I think Maruti, to my mind, should continue to do, seriously well. If the automotive industry is on an uptick, Maruti will probably be the first company to, benefit out of that.
Hiren, the other sector, the next sector number 2 that you mentioned is cement. What are the ideas there?
Well, I'm not going into specifics, but I think that if you look at any of the larger companies, the valuations are now quite reasonable, whether it is, in fact, if you look at ACC, Ambuja, or even Ultratech, all these large caps are trading at reasonable valuations. Especially companies like Ultratech have almost a pan-India presence now. So they are able to take advantage of opportunities of growth in several pockets that might come up. So I think overall as a pack, the larger companies, look to be pretty attractive.
The reason I asked you to name names there in the cement pack is because one doesn't see any big triggers for the sector as such. Valuations, yes. But that isn't reason enough. You need some triggers as well, right? Roads you mentioned, but that only consumes about 5 to 7% of the cement produced. So it isn't meaningful in that sense.
So, I think there are a couple of things that could work for cement companies towards the second half of the year. One is that if we have a good monsoon, a large part of the cement demand is for housing construction, right? And if the rural economy does get a push, as is being sounded out, given the budget preparations that are going on, the sound bites that are coming out is that there will be incremental investments that will be made in the agriculture sector because of the stress that we are seeing, and hopefully we're not third time unlucky. So we've had 2 back-to-back monsoons, and if from a probability perspective, if this monsoon is better, then you will see some of the rural housing demand coming back, and construction activity also improving in the second half as government continues to focus on the infrastructure sector. So I think the opportunities will come there, and as I said, I think to some extent, while volumes are important, but cement has now become more of a price story. There is greater pricing discipline within the sector compared to where they were. Also, we must keep in mind that costs are coming down for cement companies because fuel costs are coming down, coking coal prices are coming down. So there is some cushion that they have on the cost side as well.
What should one focus on as far as private banks go? What names?
Well, I think all mostly the idea would be to focus on private banks which do not have legacy NPA issues. I think that because the public sector banks are still 70% of your banking sector, and they are still struggling with NPAs, and they need to be aggressively recapitalized. I think that the private sector will continue to take market share away from the public sector. So I think they will. I think both private sector banks and NBFCs are better placed to keep growing in an overall environment where credit growth is very tepid. So I think that will continue to be an area of growth. But again, as I said, one has to look for companies which are not saddled with NPS, so that they are able to take advantage of lower cost of capital. And I think you will see another 50 basis points at least of costs coming down as we go into the year, because inflation continues to remain very benign.
You were talking about consumer staples earlier, Hiren, as a space where large caps offer good risk reward. Again, can we be a little specific there? Identify some names?
Yeah, I think consumer staples, though valuations are slightly on the expensive side compared to the overall market, but given the fact that earnings momentum is still on their side, as I mentioned, because they continue to get benefits out of lower crude oil prices. So I think they do have some maneuvering, and I think urban demand seems to be picking up, while rural demand continues to be a challenge.
But in many cases, even as sales growth has remained tepid and has not picked up, EBITDA margins have also come under pressure or have not grown, largely because of competition, right, in that space. A new large player, not a new, but a growing large player in the unlisted space. So companies have to spend a lot more on A&P, advertising and promotion.
Yeah, so I think, as I mentioned, it would depend on the competitive intensity in each category. So you have to look at category by category. If there's more competition, you may have to reduce prices. But at the same time, they do have the ability to spend more on A&P to drive their top line, right? In fact, the other sector which might do well as a result of that is media, because media spends tend to get a lift up when consumer companies tend to start spending more money because they have greater savings from raw material prices.
On that positive, rare comment about media, let me thank you, Hiren. Let me wrap up the conversation. Appreciate you joining in very much. Thanks indeed. Hiren Ved, the CIO, Alchemy, with that perspective coming in on the market.